Dom Chu, what is in today's Market Navigator?
We're going to talk about that NASDAQ trade a little bit more and go into the internals of the biggest influence, which is Apple, the biggest weighting in the stock index. Now, it's a very big week ahead for Apple. The company's launching its Apple Intelligence AI products, releasing new iPhone sales data. Its latest earnings report is due up here. The stock is up more than 35% in just over the last 6 months or so and over the last year. But our next guest has some thoughts on how to protect some of those gains if you are long that stock and worried. So joining us now is Mike Khouw, chief strategist over at OpenInterest.Pro. Mike, this is a very pivotal stock. Some would argue one of the most important, if not the most important, report of the earnings season by its weight, and NVIDIA, of course. Take us through what you think is the downside scenario for Apple and why you are looking to protect it.
Yeah, I mean, your earlier guests actually were just talking about the fact that Apple's valuation is really getting pretty heady here. I mean, we're trading around 35 times forward on a price-to-sales basis. I think it's about as high as it has ever been. The last time we got up to valuations like this on an earnings basis was probably the tail end of 2021. Not a great time to buy the stock. Of course, it fell about 30% over the course of the following year, along with the market more broadly. But, you know, this isn't necessarily a real growth story. I think the iPhone 16 sales, which I think some had thought, and originally even I had thought, might represent a refresh supercycle. I think it's probably going to be more like 3%-ish year-on-year growth in iPhone sales. So it's a spectacular business, but it's priced for growth that I don't think we're going to see.
Now, what exactly is the strategy then? If you are long the stock, the simplest thing in the options market is to buy a put or downside insurance. But you're taking it a little bit more nuanced with how you put that insurance protection on. What exactly is that?
Yeah, that's right. And one of the reasons for this is that, number one, it is, of course, probably the most broadly held stock. It's for any closet indexers out there, they're going to continue to hold it. So the stock doesn't tend to move very sharply on earnings. It tends to trend. You're probably looking on average at moves of somewhere in the 4 to 5% range. In fact, going back a decade, you know, the worst case I actually saw was somewhere between 8 and 9% to the downside. So buying a put, of course, is an outlay of premium. You need the stock to fall precipitously before that insurance really kicks in. So what I was looking at is something called a put spread collar, where you buy an at-the-money put, call it the November 230 puts, then sell an out-of-the-money put. I was looking at the 215s. Bear in mind, you know, we're looking at maybe 4 or 5% moves, probably in the worst case, and then selling the 240 call. When you do that trade as a package against your long stock, you're not really laying out any premium. So you still get participation up to 240. Bear in mind, you know, the all-time highs here are just under 238. So selling that upside call is basically giving away any upside beyond its all-time highs. And it gives you, you know, modest protection in the event that you get a pullback of, you know, call it 4 or 5% or so.
All right, big week for Apple for sure coming up. Mike Khouw, have a nice weekend, sir. We'll see you soon.